Hi, today I'd like to talk about how to avoid getting audited by the IRS or any other tax organization like your state tax organization. The first thing to do, and this may be a shocker to most, but the biggest item that you should be careful of doing is not lying on your tax return. Lying is a felony, and when you sign that tax return, if you put items on there that are incorrect and the IRS catches you, that's going to be a big problem. In fact, the most serious penalties, and when they levy the most serious penalties against an individual or a company, is when people have lied on their tax return. They knowingly misled and signed a tax return that had numbers on it that were incorrect. And it's extremely important that you just put the correct numbers on there. If everything on there is legitimate and the IRS comes and audits you, you're going to be fine. Even if some of the numbers are different than what the IRS may expect for your average taxpayer, if you don't include anything that's incorrect, you'll be fine. So, and this is a very short item that I'm going to talk about, but it is the most important. Just make sure that everything on there is correct. A lot of times people ask me, should I put this on there? I don't want to get audited. For a legitimate expense, they don't want to put too much of one expense, or they don't want to put an expense at all. They're nervous about it because they think they might get audited. If it's a legitimate expense, put it on the return. You're eligible to take legitimate expenses. So the second item that I want to talk about, and this is generally, I would probably say, one of the most common reasons that a return gets audited. And generally, this is not going to be an audit like the olden days where they came down to your office and asked you to show them all the forms. These days, most audits are done via mail. They send you a letter. They ask you to explain or show proof of the expense that you had, or they'll send you a letter denying something, and you'll have to prove that you had an actual expense. But most audits these days are by mail. They'll just mail you something. They'll mail you a letter, and you'll have to provide some sort of documentation and or make an adjustment to the return to make the return correct, and or just provide documentation that it is already correct and go on your way. Now, this is not a reason to get scared. People get IRS letters all the time, and a lot of times these IRS letters will assume that the return is incorrect, and they will levy penalties and add the extra tax onto the return, and people get scared and they just pay it. Don't just pay it. A lot of the times these letters that they send they're just computer generated, and basically it's just a matching item. So in other words, if you get a W-2 or a K-1 or a Form 1099 from an institution, like you get a 1099 from your bank, a lot of times this happens. People miss dividends or interest or stock trades. They forget to put that on their return. So the IRS is expecting that. So when they review your return, the computer reviews it. Basically, they'll be looking for, okay, you were supposed to get you're supposed to report $500 of dividends from TD Ameritrade. We don't see that on a return. Either you could have left it out, and so they're going to want to see it there and you left it out, or it could possibly be that you included it in another item and it's the name is different because you wrote the actual stock name and the amount was slightly different, and they completely don't match the two together, and they'll send you a letter asking for extra amount of tax and penalties and all of that. And a lot of times these things can be corrected just by going back and figuring out what went wrong. So And that comes to my second point. My second point is make sure that every single amount that you received as a 1099 or a K1 or a W2 is reported on the return. And this is especially important in a business. A lot of times in businesses, you'll get 1099s from all the people that paid you throughout the year, and you want to make sure that the gross amount on your Schedule C, the amount of receipts, is at least the amount of the 1099s, if not higher than the amount on the 1099s, to make sure that they see that you're reporting all the receipts that you received during the year. So that could be for your Schedule C or 1099s that you receive from your brokerage account, like Morgan Stanley or any investment, E-Trade, whatever it is. And you want to make sure that you report all of that on your return. And missing that will generally be an automatic letter from the IRS. So just double check that you have everything before you file that return. The last thing is, so the way the IRS works is they generally have percentages. So let's say, and I'll give you a few different examples and what to look out for. So let's say the average person gives 5% of their income to charity. So let's say the average person who makes $100,000, they give $5,000 to charity. Now they see a return come in. You sent in a return. You made $100,000, but you gave $25,000 to charity. They're gonna be like, wow, this is abnormal. Maybe we should check to make sure that this person actually has receipts for all of these transactions. They approve that they gave this amount to charity. And the same goes for pretty much every other expense. I'm not going to go through them all, but on your Schedule C or on a business return, if you have, say, travel expenses of 20 or 30% of your gross sales, in some industries they may be like, wow, that doesn't make any sense. This guy is he's a local technician. Why does he have travel expenses all over the world? Maybe he's putting his vacation travel expense on his Schedule C, on his business. So you want to keep in mind that's how they basically calculate things. Another item that comes up a lot will be business use of home on the Schedule C. Business use of home, a lot of people will put, let's say you have a 5,000 or let's say a 3,000 square foot house. And I've seen this before. People say, I use, out of 3,000 square feet, I use 2,000 of it for business. The IRS is going to be like, yeah, right, unless you actually have no other location and you actually do that, and you have proof of it. I see a lot of people who exaggerate their business use of home percentage. Then they'll say a huge amount of square footage that they use for their office, and the IRS will come back and say, prove that. They're looking to see something around 10%, probably. So you want to just keep that in mind. That's how the IRS generally operates. They really just compare numbers to what they're expecting to be the norm for that number. And that really falls for any number. It could be medical expenses, it could be contributions to charitable contributions, it could be business expenses, it could be all sorts of things. You want to make sure that the numbers that you are putting on your return reflect reality. So I'm going to go over three different things that you need to do. First of all, don't lie. Easy. Don't lie. Don't make anything up. Don't exaggerate. Second thing is, don't miss any forms. Think about all the places that you had your money, where you have interest, where you have dividends, where you sold stock, where you in your business, all the you should receive at the beginning of the year in January, you should, and early February, you should receive all the 1099s from all the companies who are going to report they paid you money for services. And so you want to make sure that your business return or your Schedule C reflects that amount of income. You want to make sure that your W-2 is on there, that all the forms that you received throughout all the income items that you received during the year are on the return. The last item is just be aware that if your certain percentages are way outside the norm, that you might get audited. And be aware that the only thing that I would say, obviously I already covered don't lie. So if you're not lying and you know that you gave a ton of charity, let's say you actually did give $25,000 to charity, and you legitimately gave it, but let's say 3,000 of that you don't have a receipt for and you don't have any proof for it. Let's say you happen to have cash or something and you never got a receipt. Then maybe you might want to leave it off your return, because if the IRS comes and they audit that, they're going to disallow that and might give you a penalty for that, because you don't have any documentation for it. So just keep that in mind, that's how they generally audit things. They're looking for patterns that are out of the norm. So make sure that your numbers are inside the norm, and if they're outside of it, make 100% certain that you can substantiate it, that you can prove that you had that expense. I hope this answers all of your questions about how to avoid getting audited. If you'd like me to answer any further questions, please leave a comment below. Please, if you enjoyed this video, like and subscribe and share it with other people. Thank you and have a great day.